Good morning everyone, my name is Saqib Ryan. I'm the resident crude oil trader here at JNF Capital. The date today is Tuesday 3rd February 2015. I will be giving you an insight into the movement in crude oil and how I'm looking to position myself in the market. Before I get started, please note investing in the financial markets is not for everyone, as losses can exceed deposits. Now, those of you who have been on my crude oil report, you will know that I have been short crude oil. I have been a bear on crude oil since the 105 handle. And as you are aware, I always make it very clear not to marry yourself to a position, to analyze as we go along. So generally, I always explain that the markets, of course, you're aware, are made up of bulls and bears, buyers and sellers. So it's very important to have a look at what both sides are doing, so that we may then align our funds in the direction of the winning entity. So what are the bulls and the bears focusing on this week? Now, let's take a look at the bears, okay? The important thing is we need to look at and see what the current factors are affecting the market price. Now, I do know obviously that the traders are generally focusing on the dollar. Now, the dollar has surged about 5% in recent times. Now, why is the dollar climbing? One of the main reasons behind this is that the Federal Reserve is potentially looking to raise interest rates at some point this year. Now, because the market is a self-discounting mechanism, traders will generally price that interest rate hike into the dollar before the actual interest rate hike comes. Now, another reason is basically capital inflows from investors. The dollar is strong, and this basically attracts investors to the dollar. Okay. Now, how does the dollar affect crude oil? The correlation is negative, as I always explain in my videos. As the dollar rises, the prices of commodities will tend to come off. So you will find that crude oil will come off. It has been coming off, and the dollar has played a major role in this. Moving on from there, let's look at the supply side of things, which is another bearish factor. As you know, as I keep saying in my reports, in my previous videos, we are oversupplied. But by how much? Now, last week we were expecting inventories. Inventories are released every Wednesday at 3:30 from Cushing, Oklahoma, and it gives us an insight into how much crude oil is being consumed. Now, last week we were expecting a 4 million barrel build in inventories, so an increment in 4 million barrels. The actual figure came out to be just north of 8 million barrels. This naturally tells us that a lot less crude oil is being refined as per our expectations. Naturally, that's bearish for prices. Now, look at the storage capacities. Now, oil in storage last week reached 407 million barrels. This is the highest recorded figure since basically records have been taken. Now, we're talking about since 1980. So a lot of oil on tap. From another perspective, we have OPEC production. Of course, this is very key. What OPEC does affects the price of oil directly. Now, OPEC production has risen by 80,000 barrels. One would expect that with oil prices falling as fast as they are, OPEC would be looking to cut production. But as a result, as a matter of fact, they're not. They've actually raised production by 80,000 barrels. Now, this 80,000 barrels is a result of what's going on in Iraq. Iraq raised their production to 35-year highs in the region of 4 million barrels. Now, basically that has pushed total OPEC production up to roughly 30.48 million barrels per day. Now, of course, as you can see, there's a lot of supply in the market. There's headwinds from the dollar as well. Like I explained, for every bear there should be a bull. So what are the bulls looking at? Now, last weekend we had to the close of the week on Friday, we had some amazing price movement in crude oil. I mean, we had a very strong close on crude oil. It rallied quite significantly, almost 8%. Now, what was the reason behind this rally? Even yesterday, Monday, it continued to rally. Couple of reasons, okay? First of all, crude oil is overextended, okay, to the downside. So we have been expecting a bounce in crude oil, and I think we've just started getting that now. It's well overdue. One of the factors that affected crude oil that caused it to rally this way was a very drastic drop in rig counts. This is a decline of about 24% from the highs of 2001. Of course, a drop in rig counts will generally mean a drop in production. This week we've seen that 9 refineries in the US have gone on strike, and that caused a little bit more volatility in the price of oil and a bit of a short squeeze. Now, 9 refineries going on strike is significant, but if you dig a little bit deeper, you will find that the union that represents these 9 refineries also represents about two-thirds of American refineries. Now, if these two-thirds refineries were to go on strike, I'm sure you'll agree that that would be quite a strong, that would have quite a strong impact on crude oil prices. And keeping in mind that the oil market, all the financial markets are a self-discounting mechanism, two-thirds of disruption in crude oil, if that were to happen, and let's just say it basically sustained itself for 3 months, because the last time these refineries went on strike, it lasted 3 months. Now, that will, of course, the traders immediately start to price that into the market. Hence, we saw another bounce in crude oil yesterday. Okay, this panic type of buying causes a spike in the markets. Okay, it can cause it in any markets, but in this case, it's the oil markets. Now, a spike in crude oil at these current levels will basically be very significant. And it's one of the reasons that the oil rallied 8% on Friday. You have to understand it's not necessarily buyers coming into the market, but also stocks being cleared. There is a short squeeze, so there will be profit taking from traders who have been short for a very long time, and there will be basically weak shorts that are being forced out of the market. That is what causes that sudden spike up. For anyone that follows the market very closely, you may see that the market could be trading at $46 or $44 in 1 minute, and you turn away, you look back, and it's trading at $45. A 100-point jump. That's quite indicative of a market that is triggering stops, and people are being forced out of their positions. Those are some of the bullish factors that are in the market at the moment. Another thing is that we've just heard rumors that ISIS is on the rampage again, like they were last summer. They've popped their head up again. The rumors we've heard is that they've attacked, they're fighting in Kirkuk. Now, Kirkuk in Iraq is basically responsible for the surge in Iraqi oil production, which pushed them over 4 million barrels. Now, if ISIS is able to disrupt production from any of these refineries, we will see a further surge in oil prices. These are the basically the main reasons that we see oil prices moving the way they are right now. We're overextended, okay, so the market is looking for any reason to bounce, and itchy bears are looking to take profits as soon as possible. So that's what's causing the spike in the crude oil prices right now. So what are my trading levels this week? Well, let's start with last week, first of all. As for those of you who have been receiving my oil reports at the top of the week before the market begins, you will know that I was short at 46.20 and I took profits at 44.60. That's roughly about 160 points. To monetize that for you, let's just say I had traded that for yourself, $30 a point. For 160 points, you're looking at a gross profit of about $4,800 last week. Now, of course, not all clients get the full swing, and there will be losses with our service. This week, of course, I am looking to engage a long position. Some of my levels have already been triggered. Now, as I've always explained, I'm a trader, not an analyst. Okay, in my opinion, there is a difference. Okay, an analyst will give you his opinion on the market, and even if the market is going completely in the opposite direction, you will generally refuse to amend his projections. A trader simply has lines in the sand, where he's buying, where he's selling. So when those levels are breached, he then looks to engage those positions, and potentially benefit from the short-term swings as well as the long-term investment perspective. Okay, so we've been short quite a long time, since 105. Last week we ended in the neutral zone. As you know from my old reports, I have a buy point, a sell point, and a neutral zone where we do nothing. Last week we ended, the market ended in the neutral zone. This week it has breached one of my buy points, so I will absolutely not hesitate at all to go long. There are bullish factors in the market that could potentially push the prices up to my targets. So I'm simply looking to benefit from the swings in the market. Now, if you would like an insight into my exact trading levels, where I'm trading them from, and the reasons behind that from my report, please do get in touch with me. You could use my contact details on the following screen. Alternatively, you could follow me directly on my Twitter. My Twitter handle is @OrionOil. I generally tend to immediately share my opinion on price action in the market as it's happening, so you'll get a live insight into what's going on. So occasionally I even share some of my levels as well. I thank you for joining me this week on the video, and I look forward to seeing you next week.